Okay, welcome to another video. We're going to be talking about the gold price in this edition, and so what we're looking at here is the weekly macro themes report, and this is the report that goes to our institutional clients. And if you want to take a look at this report, just click through to the information section of this video and we'll have some instructions there on how to get your hands on a copy or even get into a free trial and check out what we've got to offer. So we've got a few other interesting topics in this report here. You can see grain commodities, there are very interesting things going on there. The renminbi, that one's very interesting setup there. It's been very quiet on that front, but not potentially for too long, given some of the analysis that I've undertaken there. And global property prices, very critical element there for any macro investor, any top-down driven investor, and country expected returns, which are of course of high interest for any asset allocator. So going into gold, is it a breakout or is it a fake out? And I'll give you the spoiler. If you want to stop watching the video, I'll tell you all you need to know right here. Gold has not broken out yet and still faces considerable headwinds. If anything, short-term downside risk is elevated for the gold price. So why would I say these things? Well, it's because I've seen them on the charts, and the way that I look at the investment world, the way I think about investing markets, is that you should be, number one, very much data-driven. You should be focusing on the facts. You should be seeing things as they are, not as you want them to be. And that means that you look a lot at indicators, that you track how the data is trending, you try to detect patterns that have happened in the past, or what the overall picture reflects and means. And so I've come with this conclusion basically, really as a result of these two charts. I mean, these two are very much supporting, and we'll get onto those in a minute, but really, it's these two, and in particular this one here. So the blue line is the Krippner shadow Fed funds rate. Now what that is the US Federal Reserve's key policy benchmark rate, but it's been adjusted to allow for the impact of quantitative easing. So you can see there at the height of it, it's inverted, so it was almost -6%. And really what the key takeaway from this chart is that whenever the Fed has been doing quantitative easing or cutting interest rates, that has been supportive for the gold price. And since then, when it was doing less QE or winding it back or hiking interest rates, that's been a headwind for the gold price. So the tide was coming in here, the quantitative easing tide was coming in here, and the monetary tides, they're going out here, and they continue to go out. As a matter of fact, this headwind to the gold price is only going to get worse as the Fed goes to hike rates. Probably once more this year, and then further into next year. But probably the key point is that just as the Fed was doing quantitative easing then, we're about to embark into a period where they're going to be doing quantitative tightening, if their plans are anything to go by. And I've talked about that in the latest report. So the Fed has actually announced plans on how it's going to go about normalizing its balance sheet, and that translated means it's going to be basically reversing the effect of quantitative easing, but in a sort of passive or systematic way. And so really the bottom line there, during this period, the gold, the monetary tides were coming in. This period here, the tides are going out, and that's a headwind to gold price. Then you look at this one, which is represents some timing sort of considerations. So you've got the gold price there trading through this trend channel. What's the use of a trend channel? Two things. First of all, if it breaks out of it, then that often means that you're into a different trend, or that you're into a sideways market. Now, the other implication of a trend channel is that the price, if it doesn't break out, will tend to find a floor and a ceiling throughout that channel. And we noticed that happen there in 2016. Came up to the top end of that range of that trend channel, found the ceiling and came back down. And the other thing that you'll notice there too probably is that this here red line is gold implied volatility index, and that's just, think about that as you would the volatility index or the VIX for the S&P 500. So when it came up to the top end of that channel, you also had a compression in volatility. So it came down to the low point. And, you'll notice, as you go back in the chart, whenever you've had these sort of grind downs or big crunches in volatility, it's often preceded a bigger move, to the downside there and to the upside there. And if you've got a sort of a medium-term headwind and then a short-term headwind of being at the top end of the trend channel, and you have this little indicator here that says something's going to happen, we're not sure which way, but something's going to happen probably, then it tends to give you that sense that the short-term risks are elevated, and that's why I've came up with that conclusion. And then, as I said, we'll go into those second two charts. Really, this is just illustrating the fact that gold tends to trade, quite in line with what's going on with real yields, and why that's important. This is a longer-term view of US real yields, so going back to 1953, and then you've got the long-term average, tends to have this bit of mean reverting tendency. So it'll go on very large expeditions away from that average, as it did to the downside and the upside there. And then it spent these times where it's more in line with the average. I would say that, you'd expect that it's probably going to attempt to mean revert again. And so what that would do, for example, if it came all the way up there, that's about 100 basis points, 150 even, that would take it down, because remember, this is the real yield inverted, and so that could take it down to that sort of 0.5 or 1% level. That would take gold below 1,000, and taking gold below 1,000, that's unthinkable to some people. But if the last couple of years have taught us anything, even outside of markets, perhaps on the political front, just about anything's possible these days. So it's certainly a risk to be mindful of if your view is that gold does go up over the long term. Even the short term, you've got to be aware of these risks. And so that's probably about wraps it up. I mean, I guess I'd finish off. One thing that this chart highlights, and this one, if you're bullish on gold, if you're a bit of a gold bug, you're going to be wanting to pay attention to this point. So just as the tides were coming in, the monetary tides were coming in here for gold, and that was supportive, and then the monetary tides were going out then, you can guarantee that when we come to the next crisis or a recession, the monetary tides are going to be coming back in, and that's going to be positive for gold. And so really what that says is that, it just validates the point that gold can actually be very much a valid and useful diversifying asset. So, that's certainly something to think about in the context of a broader portfolio. So I'll just leave it at there, and just to reiterate, gold is not broken out yet and still faces considerable headwinds, as I mentioned, and even particularly so in the short term. And look, if you've got any questions or comments about this, definitely be sure to put them down in the comment section below, and definitely go ahead and subscribe to the channel if you like this, because I'll be putting more of the same out over the coming weeks and months. And of course, if you thought that this report was interesting, or if you wanted to have a closer look at some of these other things, then definitely click onto the information section of this video. We've got some instructions there on how to get in touch, and how to go about seeing if you want to evaluate what we've got to offer.